The next question actually is an open question, and what would happen if the government did not intervene? And I think this came to bear yesterday with we had both sides of the aisle asking the question, what is the next thing we're going to do? So the question here is, would a market correction occur naturally if the government did not intervene? What would you suggest? Mitch, you want to start?
It's going to follow through like this. You'll continue to see sell-off in the equity markets. Credit will continue to contract. The pace of economic activity will slow. That construction project in New York City to build a new office building and then furnish it with furniture from Steelcase or Hayward or Herman Miller, that gets canceled, so those orders don't get placed with any of those three companies. And then all of a sudden we see additional layoffs occur here in West Michigan from those. I'm trying to put in a personal level that everyone can understand here. At that point, there's probably a fairly good chance that the dollar begins to weaken appreciably out there as our economy slows. Foreign investors pull money out. The Fed, in an effort to defend the currency, raises interest rates to try and prevent a run on the dollar to varying degrees of success, further exacerbating the slowdown. The economic activity contracts at an even faster pace globally then because of that. And we have an intractable period of economic growth or contraction that could stretch 2-3 years before you begin to rebuild investment and you begin to get people trying to rebuild the domestic economy and the global economy. That's cheery, isn't it?
As an add-on, he mentioned currency. There are certain kinds of industries that only deal in U.S. dollars, and one of which you've heard the effect of the U.S. dollar being weak and the effects on energy prices, on oil prices particularly. Think about the potential. Now, if you go to London, you pay about $9 a barrel, or $9 a gallon equivalent, maybe $10 a gallon. So they're already used to it. We're not used to it here. So this is critical.
Thank you. John, the question for you is, please comment on mark-to-market issue and if changing this would affect our current crisis. I know you hear about that every day.
Twice. So I think there's a little bit of a misnomer about it all. First of all, there's a new accounting standard called 157, and that's the one that's getting the black eye. And basically, it's only a disclosure standard, and really if you are an investor in one of the large financial services type companies, I think it's actually good information for you because it tells you about the quality of the way they determine the fair value of the assets on the balance sheet. The issue really is that the accounting standards written for mark-to-market accounting or for how you fair value an asset is really based on where there's an active market. And so what they're really saying is, okay, you value it based on, what's the highest and best sort of value for that particular security. The problem we have right now is that we don't have markets for many of these securities. And so as a result, they don't have a value. So they don't have a value following the accounting standards that were written for a different time period. And so I think what the accountants have to do is really, our guys in Connecticut come up with some new flexibility that says, okay, look, in a down market or a problem market when values are unrealistic, that you've got to look at cash flow models. I mean, one of the guys gave the example today about, they're performing loans, but because nobody will buy them, the value's not where it is, but it's much less. And so the same can be said for any of these other securities that right now are causing a problem, and everybody's saying, the accountants have killed us, but the standards are really written for a different time.
Okay.